Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. We're going to break it into our normal 3 segments, and we want to look at segment 1. We had a decent spike in U.S. build, but we want to look at, is it going to last? Is it something that is just more of a one-off and then we'll come back down, especially given the issues that are happening with the Keystone Pipeline and into Pad 2. Then in the second segment, there's really been no bounce in demand. We want to look at where is demand right now? Are the builds going to accelerate? And the short answer is yes, and they should accelerate. The question is always going to be the rate of change versus historics. Are we building faster than normal because of imports increasing and slowing demand? Or are we going to build slower than normal? And those are some of the key pieces that we want to look at and how that's going to impact us on a pricing basis. And then we're going to talk about OPEC, because OPEC cut their demand estimates. The EIA is essentially saying that there's going to be price increases. So we want to look at what is the likelihood of the demand side, the pricing side, and what is going to be some of those key dynamics as we look at differentials going into next year. So with all that being said, jumping right in here, you can see the total amount of oil and products. So we flipped to a deficit. We went from a plus 9.7 to a minus 5.5 on total oil and products. But as we said last week, we're getting to a very tight pinch point where any real fluctuation can put you into deficit and surplus. So right now we're in a fairly stable band at this point in time. There's really not too much to see one way or the other. Realistically, based on where demand is, where things are going, we don't see too much happening at this point. If anything, we kind of hold fairly close to that level on the average, and it's really going to be driven because we do see a lot of builds in gasoline. We do see some additional builds on the heavy resid and heavy disti side. Middle distillate still going to be in a fairly tight spot on a global basis. And then it's going to come down to oil. What is the timing on going from transit into floating, then from floating onto land, and that's going to fluctuate as well. So when we look at crude stocks, flipped to deficit, went from positive 14.9 to negative 2.1. But same thing, you're getting into a fairly tight band. Obviously, we had builds today in Europe and in the U.S., so that's going to put us a little bit higher. Excuse me, we will get some increases in floating storage, just given where flows are in general. But we're going to go through that in a moment. Total oil product stockpiles, the deficit now are from 5.2 to 3.4. And a lot of that is on the back of gasoline. So we did get some builds in middle distillate that will kind of flatline for the most part or fluctuate for this at this point. But realistically, on the gasoline side, that's going to be a big driver. On the heavy resid side, on the residual, on the heavy disti side, that's going to continue to drive up, and that's going to pin us, realistically, right at that average or just above. But you can see that we've come pretty close back to normal, as we've been saying this whole year, as we've seen the comps getting easier, this steady build. When we look at the U.S., as we had been highlighting, imports of Nigerian crude rose to the highest in a month. That's going to continue, and what's one of the big things that as we go into next year, if Saudi Arabia and the GCC in general really wants to clear some of the glut, I think you could see them cut OSPs more aggressively into the U.S. because that could be a spot that would be of interest. The Europe is kind of tough right now, only because you have CPC flows increasing. You have Libya that's fairly stable right now. You have U.S. exports of light going into it. And then they're picking up their normal allotment of Middle Eastern cargoes, and West Africa is not so much a swing as it used to be. Some of that is coming into the U.S. Latin American flow is also increasing, and that's taking some of that demand. So West Africa is really that swing producer at this point and swing provider, which is why we talk so much about where the Angolan and Nigerian crudes are going. That's complicated further when you look at Russia. So Russian oil exports jumped by 270,000 barrels a day to 8.1 million barrels in November, which is the highest since April. And a lot of that is on a big increase on diesel exports. And that's what we had been highlighting previously, with a lot of that diesel going into the Middle East, either for commingling and storage to get re-exported or for local consumption, and that then allows the Middle Eastern countries to export more product. Either way, that's where you're starting to see this shift. And then shipments to India continued to rise. Overall, crude loadings were unchanged, which is kind of in line with what we were saying, while diesel continues to be the driver, a lot of that going into that market. Crude exports to the EU fell to 430,000 barrels a day to 1.1 million. Seaborne volumes dropped, and that's something where when you look at deliveries in general, there's a lot happening on the delivery side. So there's talk that Russia is going to reduce even further their exports of crude into Europe, especially into Germany. And there's now talk that Kazakhstan could use that pipeline to send it through. And it's interesting because that's another way around the cap, because, and don't get me wrong, maybe I don't have better things to do, but on the way home from work, I'll think about different ways that they can get around the price cap. And one of them was actually calling it a different grade in the pipeline, putting that through and then blending, and then you have a kickback for that blending. And I think it's an interesting side. We've seen it happen in Iran, Iraq, so it's not crazy to see. And a lot of that, it usually comes down through Basra, where Iran either allows Iraq to pull harder, or they because of some of those fields are right on the border, with half sitting in Iran, half in Iraq, they can then essentially pass through. So that's another way that things can happen. And it's going to be important because there's a lot of commentary on how is the price cap going to adjust pricing and flows, and the IEA is saying that it's going to push prices higher. Now, I disagree with that. I don't think it's going to push prices higher because Russia needs money. They need to finance their war in Ukraine. And by accepting this price cap, they're actually going to make more money, and they're going to push their crude a shorter distance. So the miles per ton comes down. They don't have to worry about the insurance issues, and you legitimize the crude going into it. And if you look at where Urals are priced at about right now, $48 to $50, as that demand picks back up in Europe, you could actually see it move closer to the price cap of 60, because there's still that $10 to $12 gap, which means that Russia would actually make more money, not less. And that's going to be an interesting one to watch going forward. When you look at land storage, here you can see that the deficit widened from 55.5 to 56. West of Suez, you had deficit widened from 36.7 to 38.4. That will reverse. East of Suez, you had builds in general, with the deficit widened slightly from 14.8 to just slightly less than 14.8. So you're still fairly stable. Now, the bigger issue is when you look at that conversion from floating storage to land, a backlog of tankers, as we talked about last week at the Turkish Strait or the Bosphorus Strait. That has since started to reduce. So tankers able to haul in excess of 15 million barrels have navigated. So they got upwards to about 26, 27 million barrels. Now 15 million barrels have been able to move. And there's two pieces to that. One, they provided additional paperwork to the ports, to the shipping companies to speed up the process. There was also inclement weather, which also slowed down traversing the strait. So those things have now passed. That will allow this to accelerate a bit. Land storage is going to stay at the lower end just because a lot of this is still in transit in floating storage. And that's where you get some of the disconnect between what is happening on land and what is happening at sea. Floating storage surplus narrowed from 26.1 to 23.8. You can still see that we're very much at the high end of that level and right where we were in 2021 and in 2020. West of Suez had a big spike. The surplus widened from 2.6 to 8.3. That was actually driven by Europe. So Europe is the biggest driver of where that spike has come. We had the U.S. that drove the spike, then that came down. Now we have Europe driving it. That'll come down. And again, it's just the timing between onshore and offshore. which is why we like to look at these together. East of Suez, the surplus widened from 10.5 to 14.5. We do expect that to increase just because you have ships that are showing that will start showing up, and then some of the delays in terms of when you'll go from offshore to onshore. You have Lunar New Year coming up. You have obviously the holidays from New Year's, Christmas, and then the Lunar New Year, which is going to get in the way of some of the movements. And then the Middle Eastern flows. Floating storage is still unseasonally high. It's coming down, but not in a meaningful way, which is something we're gonna have to watch as we progress into year end, but more importantly into January, because that's gonna set up what OSPs are gonna look like as we go into the new year. Then, as we look at TC Energy, they expect to provide an update on the restart of Keystone by Wednesday. It's tough. The restart was talked about today, but realistically now the talk is the 20th. So there's going to be a lot of different back and forth. Heavy sour Southern Green Canyon crude is at the highest premium to NYMEX oil futures since September 2021, and a shortage of Canadian supply on the Gulf Coast following the shutdown. So you're seeing a lot of these short-term flips, and this will reverse as you see the Keystone come back. But as long as you don't see it, that's going to pull crude from pad 2, from pad 3. So we should see some pressure to the downside on storage as this crude isn't available. But in the meantime, just an anecdotal piece, Angolan crude differentials have fallen to the lowest level since May 2020, which is going to continue to be a problem when you look at trying to clear the market. Now, as we turn to the U.S., crude stocks built 10.23 million. That's still 49.5 million below the 5-year. All of that, as you can see, sitting at pad 2 in Cushing. Pad 2 had a small build of 60,000, Cushing small build of 430,000. The build was really driven by pad 3 with a big surge of 8.76 million. And that's the difference between when are imports coming in, when are exports going out, and they're going to continue to try to move that down as we head into the end of the year, again, trying to reduce the amount they have to pay in the ad valorem tax. When you factor in the SPR, the build was only 5.48 million. So you're still seeing some of those different shifts as that does come to an end this year. So realistically, the storage is fairly normal on a 5-year basis, on a year-over-year basis, except in pad 2 and Cushing. And that's only going to get a bit worse based on the issues that we've talked about when we look at the Keystone Pipeline. Pad 3, you can see here that there's usually this little quick spike. You can see it happened in 2019. It's happened in 2015. It's happened in 2021. So realistically, it's just going to continue down. What we're seeing is we're going to follow a very similar trend to the downside, similar to 2019, 2020, where you kind of see that decline as we go into year end, and just very, very normal. And then as we get into January, you then see a quick pickup back higher, and that's always just going to be the case when you look at pad 3 flows. Cushing as flatlined, it's unlikely. Well, our view is that it was going to flat, start to curl up, and then see some acceleration into year end. That is likely going to pause just because WCS does come through Cushing. You do see some of this coming in. Given the issues on the Keystone Pipeline, you could likely see this either flatline or drop further. And then that realistically, it should reverse at some point, but it's only going to come based on when that pipeline comes back online. Runs dropped 3.3%. You had a decline of 458,000 barrels a day, so we went from 95.5 to 92.2. There were drops in activity in pad 2, pad 3, and pad 5. We do see some of that reversal, but again, we're also coming into the holidays. So typically you see a little bit of a spike, and then you see a slowdown as we go between Christmas and New Year's, and then things ramp back up as we go into January. We're still going to be above 90% utilization rate. It's not that we're going to see this huge drop. As you can see, we're still above the 5-year average, the year-over-year average on the utilization rate. But it's important to look at the utilization rate against the 5-year, because even though we're 2.4% higher than normal on a percentage basis, we're 115,000 barrels lower And that's important because when you look at the average crude oil, we've been shuttering refiners and we've been shutting them down. So utilization rates can go up, but there's less. What's running is running harder, but there's just less stuff going through it, which is resulting in some of that decline, which we've talked about. Here you can see that there was a drop, and it's important to look that there normally is a drop at this point in time. It's just the timing of when that happens varies. Here you had the drop a little bit earlier. We'll get a bit of a spike and then the drop off as we go into year end. And then you can see that there's that nice little ramp as we go into, it's always going to come down to where is the holiday recognized, when is the day off. So we're still going to stay towards the high end of that range. Imports were up 855,000 barrels a day. As we said, Pad 3, we expected to stay fairly stable, come down slightly. We did get the increase in Pad 1, Pad 2, and Pad 5. Pad 5 remaining lumpy. Pad 2, we had that makeup number that we had talked about, but now with Keystone down again, we should see some of that drop off, and Pad 2 imports get impacted as Pad 1 also drops off a bit. When you look at Pad 3, still bumping along the bottom of that cloud. We don't see that changing in the near term, especially as they try to manage those storage levels. Pad 2, we were expecting to stay at the very high end. You could see that seasonally speaking, there's usually that spike. We expected to be at the high end of that spike. But now with the pipeline issues, we do expect to see a bigger makeup number to the downside, where we'll likely fall below the 5-year average, and until the pipeline comes back, stay below the 5-year average, bouncing in the middle of the lower end of that cloud. Implied demand was down 100 in total. For gasoline, demand was down 103,000 barrels a day. Realistically, that's a bit low. We're something closer to about 8.4 million barrels. Gas Buddy also has something similar. We'll talk about that in segment 2. Distillate, bit of a bounce, 18,000 barrels. Again, we're kind of just waffling here at this point. There's not too much more to the downside below 3.4. We're not getting back to 3.9 just because of trucking, given we do have a fairly sizable cold snap coming through the U.S., which will provide some of that support, but the slowdown in trucking is going to eat into any of those increases. Jet, you have a pull through that starts now because, depending on when people start to fly, we have Christmas is not this weekend, but next weekend. So because of that, people might try to leave a little bit earlier. So we do have some of that jet fuel moving on site ahead of schedule. So, just a normal basis. So we do get that spike. When you average it out, we still think it's going to stay where we have been highlighting. Resids, small drop. Propane, small drop of 176,000 barrels a day. But the cold snap is going to help that demand piece in general. But we still have a lot of supply sitting in the market. Gasoline implied demand, you can see we're hovering at the very low end. You normally see this drop and then a spike. We're going to get the same thing, especially because you're going to have the retail side pull gasoline to ensure that it's there for the driving that happens for Christmas. Then typically you have a lull between Christmas and New Year's, and then that surge right around New Year's as people either go home and spend time after spending time with family. So we're still going to see the seasonal spike. It's just going to stay very much on the low end of that on the normal. Crude oil inventories, excluding SPR, just moving closer to 2021, which is where we think we're going to close out the year. Right along those lines. Days of supply flatlined a bit. They're going to come back up just slightly just because we had an increase in crude, decrease in run rates. But you can see that we're still fairly in a normal space. Total commercial oil stockpiles, we've moved back to 2021 levels. That's where we think we live into year end. As we were saying, a bit of a flat line. We've had a little bit of a spike. Given the slowdown in demand, some of the increase in imports, now there's enough out there to keep us fairly tight and close to where we closed out 2021. Gasoline storage moving hard. You can see the rate of change is accelerated versus previous. We should get a bit of a flat line either this week or next, depending on when that crude moves into the market. but imports have been a bit higher. Demand has been a bit lower, so that has accelerated some of these moves. And you can see we're pacing well above 2021, and we do expect to close out the year very much closer to the highs that we saw in 2020. In distillate, started to come back a bit, but you can see there's normally that acceleration. The acceleration came a bit earlier, but now we're going to flatline a bit. We do see more exports going into the market, which will help manage storage, because realistically, there is a lot of distillate in PADD 3 storage, and there's not a lot in PADD 1 storage. So that differential is going to keep those cargoes moving when you look at PADD 3 into the international market, as PADD 1 continues to find imports. Storage for jet fuel dropped, again, very much along the seasonal lines. You can see that there's normally that drop. It just varies in terms of timing, but it's seasonally normal. When you look at the crude curve, you can see that the contango has flatlined a bit, but it's just now it's kind of flat pricing here. There's still a little bit of contango. We do expect to see that remain in contango at this point. We don't see backwardation coming back, in the first few months, just because of the amount of crude in storage, the amount of production out there, and just where demand sits as we head into year end. And then when we look at floating storage in the U.S., you can see that it's back fairly in line with seasonal norms. We don't see this fluctuating too much, just because they're going to try to manage, they'll try to slow down imports. So by doing that, you should see floating storage actually increase. And you can see that there's normally this spike into year end. And that's just because they're like, look, sit in the water for an extra week so we don't have to pay these additional taxes. And then once the tax man goes away, that's when you get floating storage moving into imports. So it's just going to be that timing delay. So that's what we have here on the holistic side, globally speaking. In the next segment, we're going to go deeper into U.S. activity and what's happening across the refined products.